welcome to another exciting episode of Finance Footnotes. I am your host, Brent Stransky, joined, as always, by my friend and colleague, Zach Miner. Finance Footnotes, where we peel back the layers a couple levels to look a little deeper into the mist and determine what we can do with our finances to have better outcomes. Today, I'm going to talk a little bit about where we are in the market. I wanted to share a couple points of optimism. I want to share a point of pessimism, and then finish up with some thoughts on the political economy. I feel like the dust has settled enough where we can just highlight from a high level some of the things that are happening here as we look ahead to the next 4 years. So that's what I have
Right.
on the agenda. Zach, do you have anything fun to add today?
Yeah, I'm gonna spend most of my time talking about the big news of the week with the DeepSeek AI, the Chinese artificial intelligence release, and what that could mean for things moving forward. Definitely had some major impacts the last couple days.
Well, it's been very interesting, and I'm excited to hear more about that. It's been crazy. So we'll table our discussion until that point. But real quick, as usual, let's start with a look of where we are in the market today. It's been choppy this week, as Zach just mentioned. But I have a clipping here from the Wall Street Journal this morning, showing you the three primary index: the Dow, the S&P, and the Nasdaq. And the S&P 500, the primary U.S. stock index. It looks a little choppy there, as you can see over the last couple of months, but within 1% of all-time highs. So we'll have to wait and see how that transpires in the next coming months. But I wanted to start with kind of a quip here that I came across this week. And we talked last time when we were together about a great quote from Niels Bohr, the Nobel laureate in physics from many years ago. And he said, prediction is difficult, especially about the future. Zach, you got a chuckle out of that. Gave me a chuckle as well. This gave me a chuckle too, because I read Barron's Magazine. It's a newspaper, comes out weekly. I've quoted it here on this podcast many times. And unlike the Wall Street Journal, Barron's does give recommendations for stocks, and they typically do between 60 and 80 a year. And then they, in
Our
January,
our
review.
stock picks had a bad year.
Yeah. So just to remind you, these are very smart people who are paid to give their advice, and they have a wide syndication. And you can see of the 60 stocks they picked last year, the average return was 1.8%. Now, mind you, the S&P 500 index did 25% over that time, but I think a more realistic index could be the equal weight index, which is up about 11% last year. So I would say that was pretty bad.
That's
And when you publish every week, you gotta have
yeah.
your mea culpa, man. That was no bueno.
Well, good for them for owning it, right? They could have probably just swept that under the rug and not said anything, but yeah, that's not great.
The point I'm making here is that even the smart people, you see them on the news, and I believe the people at Barron's are smarter than the folks you see on most of the time on X or elsewhere. This is widely syndicated. They get it wrong, and I can't remember a year where they actually outperformed the index in the recent past. So they make compelling arguments every time, but just something to be aware of as you move forward here, folks. So the next two ideas I want to share with you are two. I say, these are graduate level concepts in finance. I'm going to approach them from a high level because I think they're valuable, but I think it's going to indicate where things go. It's practical, timely. The Federal Reserve is meeting today. It's Wednesday, January 29th, and they're going to release some meeting notes. And I think a lot of what's happening, Zach, and I'm sure you'll agree, is predicated on what's going to happen with the Federal Reserve interest rate policy, right? You've probably heard a lot about that, folks at home. And so this really great graph here from the Wall Street Journal last week, and it's kind of measuring over the last 10 years what's this mystical thing called neutral rate. So I have here on the slide, and Zach, please feel free to chime in here. But it's interesting because I haven't actually seen it be represented as a band before. So the orange is showing you kind of the upper estimation of the band, and the blue is showing you the lower estimate. It's not necessarily a known entity, right? This is always a guess. What is
Correct.
the interest rate where the economy is neutral, right? Where if you had interest rates above that, it would be restricting the economy, and if it was below that, it would be encouraging economic growth. So right now, you can see that the band has been moving around a bit over the last 13 years, and you can see that it is cutting down towards the upper expectation of what the neutral rate is. So I guess the thought is, we are becoming more accommodative, although it does seem like the upper bounds seem elevated. So I think all that to say, what is all that to say? All that to say that it looks like we're getting more accommodated over time, maybe two rates cuts this year. Um, I thought it was pretty graph, Zach. What do you think?
Yeah, like it represented as a band, and the neutral rate is essentially when the Fed is just kind of hands off, letting the economy do its thing. They're not restricting or not attempting to restrict the economy or attempting to stimulate it. It is Fed Day today in about 53 minutes. They'll
Fed
release
Day.
their.
Zach's kids get presents on Fed Day. He's very excited. They're gonna hand out little like
I would,
what would you hand
and
out
the
like
expect,
little trillion dollar notes from
yeah,
Zimbabwe or whatever?
yep.
All right.
And the expectation is that there won't be any moves today, that they'll hold rates steady today, and like you said, the expectation is down towards about 2. I still think that this type of chart where the expectation for the neutral rate is increasing still will leave room for my prediction to eventually come true, that they will raise the target rate of inflation in the economy from 2 to 2.5% at some point in the future. And then I'm going to stick to that until I'm proven otherwise.
I think that's reasonable. We have a great chart coming up here at the end, folks. So stick around to look at inflation over the last 10 years. I'd like to start with a cause for concern, right? And then I'll end with a couple ideas for optimism. But you know, this also printed in the Wall Street Journal this week. And it's the second advanced financial concept. I don't mean to bore you folks to tears, but if you're at a cocktail party and someone brings up the equity risk premium, you can walk the other way. But for our sake, let's just quickly talk about it. This is essentially taking the inverse of the price to earnings ratio and subtracting out the treasury yield. It's a lot of gobbledygook to say, hey, is it better to invest in a guaranteed interest rate from the Federal Reserve, or does it make sense to take the equity risk premium, the risk in stocks, right? So, you can imagine if the interest rate was 10% on the treasuries, a lot of people would be investing in bonds instead of stocks. And the reverse is true. So I just wanted to highlight this really important fact here that was interesting, that it's turned negative for the first time in 23 years, which
Yep.
indicates that future stock market returns will be muted. If history is any indication, which it isn't always, but it's reason to have our ears to the ground, looking for alternative investments that can, perhaps have better optionality over the coming decade. So,
It
yeah,
doesn't
surprised to see that.
necessarily, yeah, it doesn't necessarily mean muted. I mean, it could mean that. It just means that on a relative basis, stocks versus bonds, which are more attractive from a
Mm.
risk adjusted return perspective. And when it's negative, that says that the bond market is more attractive. The single highest predictor of future bond returns is starting yield. And so we're starting at the highest point we've had in several decades. So that would indicate that for balanced investors, growth and income investors, that having fixed income and bonds in your portfolio is once again potentially a good thing. Where for 10 plus
5 or 10
years
years,
it
it's
wasn't
been
really doing
ugly.
anything for you, right? It was really just kind of sitting there and would bolster an equity market decline, but that was about it. You weren't really earning much from it. And now you're earning, an excess rate of return above inflation, and a real return on fixed income. So
Yeah,
that's
Zach,
what I'm saying. Yeah.
you bring up a great point, and so let me flip that. Typically, when the equity risk premium is high, it's suggestive of better returns going forward. And maybe there's less correlation if the equity risk premium is low, or zero in this case, or negative in this case. Maybe it's just less correlation, but certainly
Yeah, not
less
even correlation.
glowing.
It's really so that the ERP is generally used to compare it to fixed income or to compare it to the bond market, right? It's not necessarily telling you that much about stocks itself. I mean, in a
Well,
sense, it
let's dig in deeper.
yeah,
I've seen some evidence to the
yeah.
contrary,
Well,
especially
it's the
when
same thing as that chart we showed, right? With the PE over, over 5-year forward, that the starting price to earnings ratio, if it's higher, that the equity returns tend to be lower. So it is saying the same thing.
over
So
longer periods of
you're
time.
not wrong about that, but usually it's usually just spoken about in the context of comparisons between the bond market. That's all. But you're not wrong.
Correct. Okay. All right.
We're both right. Everybody's right.
I love it. I'm gonna take it. I'm gonna clip it there. Zach, do not look ahead. I have a quiz here for you, folks. You can
All
follow
right.
along. Um, so pop quiz and then two optimistic points. First is, of a traditional 4-year presidential cycle, Zach, which is the best for U.S. stocks? Don't look
The
ahead.
first. It's the first one. It's the
The
first
first
year.
one. All right. So it had been the case that depends what term you're looking at. Okay. So we're talking about statistics, 1950 to 2024. The best year is actually the pre-election year, and that we were,
Hmm.
harped on that. So that would have been 2024.
Right.
But so interesting fact here from our friend
Oh,
Ryan
past
Dietrich.
10 cycles. I like this. This is nice.
Yeah, this is a great chart, folks, and I'm gonna hit you at the back here with a couple of questions. But so our friend Ryan Dietrich, not our friend, he doesn't come to our cocktail parties, that's for sure. But we see him on Twitter sphere a lot, and he had this really great chart, and it's showing the last 10 presidential cycles, the last 40 years, 9 of the last 10 were positive in the first year, and it tends to be the best year if you look at just the last 10. So this post-election year, 2025, if we're just looking at this one statistic, 10 observations, 9 of the 10 were positive, average 18% return. Pretty impressive. We'll have to see if that continues. Zach, you got it right. I'm not surprised.
Kind of. Well,
A
kind
little
of, I guess.
surprised.
Yeah.
Damn, a
Yeah.
little surprised. Did you look ahead?
No,
Just kidding.
I didn't
Just
look at it.
kidding. All right, so cool. Second, that first one, easy to follow along with. Typically, the first year of a full presidential term, for example, 2025, is quite good for the markets typically. Second one, more complicated. I'm sorry. The VIX was very choppy at the end of December. That's unusual. One day it was up 70%. On the 18th, that was when the Federal Reserve made an unexpected announcement about interest rates, up 70%. But then but a month later, it was basically flat. Okay. During this time, it was going down, realized, okay, actual volatility ticked up. So you had this kind of inverse where expected volatility measured by the VIX was decreasing while realized volatility was ticking up, right? Very, very unusual. This was in Barron's this weekend. Since 1990, when that's happened, the S&P is up on average 13.5% over the next 12 months. This could be, looking at the minutia and the tea leaves, and there's no real, evidence that it could go up. But I think this move in the volatility markets has, at least over the last 35 years, indicated that stocks are poised for a rebound over the next 12 months. Did you see anything like this, Zach?
No, I mean, it's definitely interesting, and it does kind of just speak to what those mean in kind of the real world when you get those VIX spikes. They're generally kind of things that come out of left field and often don't persist. Once the information's digested, things sell off on the day something hits the tape, right? And then things are digested and realize like, it's really not all that big a deal. And then the expected volatility measures decrease. Kind of just speaks like the real world aspect of it. But
Yeah.
it's definitely interesting to put the numbers to it for sure.
I always wonder what sad person sits in a closet somewhere on Wall Street coming up with these data points, and it breaks my heart a little bit. This is a very complex one. You've got this like 7 or 8 levels into the onion, but it leads me to a question for you, Zach. We spoke last time, earlier this month. We talked about our predictions for 2025 without any promises or guarantees implied, and I said I'm expecting, mid double digits, in the
Hmm.
teens, up to the 12 to 14%. And you said, Brent, you're wrong. Your eyes said that. You didn't actually say that, but your eyes said that. And you said, I'm thinking like low single digits. So here I have 2 compelling data points. Don't you
Very
feel,
compelling.
don't you feel silly now that you've made such a low, or are
So
you going to stick,
compelling.
or are you sticking with it?
I'm sticking with it. Yeah, I'm sticking with
We'll
it. I
have
mean,
to-
we saw no, just this week we saw something come out of left field, right? And it's just yeah, it's been just too nice and up to the right
All
for
right. Well,
24 months. So I'm
Well,
just
it's gonna be interesting. We'll find out. Of course, we'll keep you posted. Before I turn it over to you, Zach, I know you've got some interesting topics. Just very high level, very quickly go over some of the where we are in the political economy at the moment. I've got a couple of slides here that I want to just drill through. This was from the Wall Street Journal or last weekend, and just some of the political economy, some of the touch points that make folks feel positive or negative about the economy or a particular politician. You can see here in this first chat, this is comparing the Obama, the first Trump, and then the Biden administration. So since 2013, what things look like. Federal debt as a percentage of the economy went from 69% to 96. You can see that huge run up because of COVID, exceptional government spending. There's been a slight run up over that time, but it is elevated. So just wanted to highlight that's where we are at the moment, and I think that's why we see some of the policy coming out of the Trump White House at the moment. All the while, the S&P 500 is doing extremely well. Zach, 2013, S&P 1485. Whoa. It
Isn't
feels
that amazing?
crazy. It's crazy. And about 6,000 today, folks. So you can see there has been some chop, but typically it's been up into the right, regardless of who was in the office. The trade deficit, this is the touch point for tariffs. There's been so much conversation about this. You can also see here that the trade deficit from, when Obama took office in 2013, was 0.7 trillion. Same when Trump took office, but it's 1.2 trillion now. It's excessive. Excessive, it's the wrong word.
That's
Probably unsustainable is a better way to say it. So that's, I think, some of the policy concerns you're seeing out of the White House as well. Consumer price index, we've talked about that before. I think this is a really important one. And while maybe it hasn't hit a lot of folks who are buying gas and eggs, we have seen this precipitous drop in interest rates over the past. Although, if you compare it with the Obama and the Trump administration, the first Trump administration in 2017, man, inflation was so low at that time. My God. Um,
amazing.
Ending up at 2.9% here, it was a significant, probably well done. Would you say the Fed did a great job or good job? What grade would you give them on this?
I mean, so far, long and variable lags. You don't know if something's
We
going to
don't know the
happen this.
unintended consequences.
You don't know. I mean, you don't know if something's going to happen this year and make them realize like, oh, they went too fast. It doesn't seem like they did. And I think if we go back to kind of our podcast or any other podcast or talk at the time back in 2021 when when they were embarking on their interest rate hiking cycle. I mean, if you would have told us that in January of 2025, market would be 1% from all-time highs, unemployment would be at 4.2%, they would get the Fed funds rate down by 100 basis points, and everything would be pretty looking okay from economy and corporate earnings standpoint, even like A plus. If they can pull that off, they've done an A plus job.
It
So
seems in navigating the political risk. Yeah, I mean, it seems like they've done a great job. We'll have to wait and see what happens there. Employment rate down to 4.1%, exceptional. But yeah, I just highlight these five charts to say that the economy seems rather strong at the moment, and we'll have to wait and see what happens. But the stock market and the economic outcomes are sometimes dislocated, so the stock market can go down while people are still employed and inflation stays low. So we'll wait and see what happens. We'll keep you posted here at Finance Footnotes. Zach, turning it over to you, my friend.
all right, pop quiz. And to be fair, I didn't know this, so I would have
Ah,
gotten this wrong.
great.
um, Give me what you think the increase in the federal government's workforce since 1955, either by percentage or by number of people. What do you
It's
think?
so weird. I
What
saw
do
a
you think
chart
it's
about
been?
this because of the news in the mail. I feel like it's actually surprisingly as a percentage, like flat, like from like 1980 or something, but 1950, a
It's
thousandfold. I don't know.
it's like essentially completely flat,
Oh
which
man, I was shocked by that too, and I saw that myself. Wow.
crazy.
Yeah.
So, I mean, I wouldn't have guessed that. Now, the amount they're spending per federal worker, right? That's a whole different conversation. But the actual like number of people in the federal workforce,
Yeah, and then you
flat
think about
since the
like compared to
50s.
like and as a percentage of the overall population has,
It's way
must
down.
be a third of what it was. It's crazy. Do
Yeah,
you know, does this include, I
military.
guess
I don't
yeah.
know. Like
Yeah.
active duty military. That's a good question, and I don't know the answer to that. Would definitely like if you had, you know, there was World War II, Korean War, Vietnam, right? I don't think this includes that. But that's a
Yeah.
good question, and that could definitely skew the results. But if you look at kind of where the bloat is, right? That's
Whoa.
local
Whoa.
government, state government is
Wow.
really where that all
Oh
is,
my
and
goodness.
not too
Yeah.
much Doge can do about that. So I was just really surprised about this, since that was a little pop in for you. So we were talking
Appreciate it.
about items like that. So what I'm gonna kind of spend most of my time on is the big move that we had on Monday, the DeepSeek AI release. And first, just set the stage is kind of what happened. So this first chart,
Yeah,
we're
I
looking
think
at.
most folks at home probably missed this. So cue them in.
So on Monday, Nvidia's market. So the Nvidia fell by about 17%, which is the biggest company on planet Earth to fall by 17%. That is a major deal.
The biggest loss of any company ever in the S&P 500 history. One day.
$593 billion market cap loss, which is bigger than 487 of the S&P 500 companies' entire market cap.
Combined.
They lost in one day. Not
Yikes.
combined, but each one of them. Um,
Oh,
which is
thank God.
yeah,
Oof.
yeah, which is just a massive change, right? And this comes on the heels of the single largest A increase, which was Nvidia back in July of 2024 of 326 billion. So big move. And so what happened? And as we know, we talked about many times in the past, these Meta, Amazon, um, Microsoft, OpenAI, massive tens and tens of billions of dollars of CapEx spending, building out data centers. And inside all of those data centers are NVIDIA GPU chips. And that costs a lot of money. And NVIDIA has massive pricing power. They have 50+% net profit margins. So, this is a company that is really riding the wave and has ridden it to the largest company in the world. Um, on Christmas Day, which was kind of under the radar, this Chinese hedge fund owner released an AI LLM large language model called DeepSeek, and he kind of just quietly released it. Over the next month or so, everyone kind of started to realize that this thing is very powerful. And then just in the last week, they came out and said that they did it with a budget of $6 million and 2,000 of Nvidia's like old chips that weren't even designed to be used with artificial intelligence, which was a major out of left field type of moment. So less than like a 20th of the budget and the older chips, because we have export controls that don't allow Chinese companies to purchase the state of the art NVIDIA AI chips. So the biggest question, and this is something that everyone's been wrestling with all week, is like, is this actually true? Did this actually happen? Um, Anything that comes out of China, right? You don't know. And did they just say this and it's not true at all? My take is not really. I think that and this is something that came out today, that OpenAI has some data from their API back in November and December of very large data downloads that, without getting too wonky or technical about it, it seems like this model was essentially built on top of OpenAI's ChatGPT. So all of the work that ChatGPT and OpenAI did, allowed them to kind of get to this place.
Hmm.
Not that what they did isn't remarkable either way. I mean, it is, to be able to release their own model on seemingly
And
older
release it open source, which I
and
thought was very interesting.
open source, which is very interesting. Now Meta released Llama open source as well, so it's not like unprecedented for them to do that.
But you can kind of
Um, yeah,
look over their shoulder and see what they did to maybe get an
for
idea of
sure. Yeah, for
what
sure.
their
So
algorithm looked
it's
like.
remarkable no matter what. But I think that the baseline claim that they built this thing from scratch with $6 million and old, H800 NVIDIA chips is probably not accurate. So, and that's kind of what you're seeing the market digest in the last couple of days. NVIDIA was up 10% yesterday, it's down another 4 today. So it's just like, everything's kind of bouncing back and forth. Now we know, because if you listen to Finance Footnotes, that the Magnificent Seven and Nvidia really have driven the market returns over the past 2 years. So this is definitely important news if it means that those returns in the future and those expectations for profits and capex spending and billions of dollars of Nvidia chips being bought may not be necessary. So next two charts just show some things about this model. The first being the costs. You can see GPT-4 released in late 2023 for $40 million training cost. Apparently DeepSeek V3, which is the newest one, was done for 6 million, right? Very significantly less than what it costs. And the next chart showing the performance, and this is third-party performance scoring. So this is done by independent organizations, kind of across the four major things when it comes to artificial intelligence models, being coding, quantitative reasoning, reasoning and knowledge, and then scientific reasoning and knowledge. Those are similar but different. And you can see it competes with the best models in the world, on every category. So they've done something remarkable regardless. I don't want to, downplay
Yeah, wild.
what they've done. It just kind of depends on exactly how it got there. So what does this mean moving forward? So what it means if true, and scenario A being the worst case for the chip makers and data center build out, and essentially could mean if it's true that the billions of dollars of big tech capex is completely unnecessary, and that the cutting edge model performances can be done which with much less than previously thought. You don't need to spend $50 billion to build out this giant data center in order to create these models. Maybe you can do it for 10 million and cheaper chips. That would be the worst case for Nvidia, worst case for data center companies, that are building out the industrial companies that are building out the data centers. Um, if that ends up being true. But that would actually be good news for the LLM builders and consumers. So Meta, Amazon, Microsoft. Meta was actually up on Monday on this
It's so
news
interesting to see. Probably for this reason, I suspect, right?
because that could potentially mean they don't need to spend, like Meta's spending $60 billion this year on data center build out. Maybe they don't have to, right? And so all these companies that are doing that would benefit from this news because it means they can do what they're trying to do cheaper. It's also good news for consumers because it could mean that they'll have access to much cheaper AI. It could be more ubiquitous. It was all, like you said, it was also open source, so folks are able to download the entire model and run it locally, like on their own servers, without any connection to China. So that's very interesting as well for consumers. So there's a kind of and that's why you see some of the market reaction on Monday wasn't like the whole market fell down. The Dow was actually up on Monday. A lot of healthcare companies were up, cash flowing companies were up, because it's the idea of like, hey, all these, the productivity increases from AI might be cheaper and more widely available than thought. Was really concentrated in the chip and data center basket was what went down so much because you might not need as much of that.
And despite the fallout, Nasdaq down about 3%, S&P down, was it less than 1%
I think it
on
ended
the
up being
day?
less than one or right around one. Yeah, it wasn't too bad.
Yeah, this is interesting, and I guess from my thought process, Zach, and I think it's kind of what you're saying here is for, at the end of the day, Nvidia ends up being like a bit of a tax collector, right? So if you're a tech company and you need access to the best, smartest, fastest chips, you know, you have to pay up and you have to wait to get them from Nvidia. Now, if you don't need to do that, then it's possible that society gets all of the good that AI can bring at a tenth of the cost. And that might have some
Possible.
real halo effects for the markets outside of data centers and chip
Definitely.
builders. So we'll have to wait and
Yeah.
see.
Yeah. And so scenario B, what if it means if true again, if this is true, the scenario B, the best case for the chip makers in the data center build out is that we've actually only just scratched the surface of what is possible with AI. And while the current, GPT-4 level performance can actually be achieved with much less, the hyperscalers, the ones with the big data centers and all the latest chips, are about to release like unimaginable capabilities, right? It's gonna be the next couple of years are gonna be crazy of what they're gonna release and the capabilities of these models are gonna get to. That's the other side of it, right? And then in that case, all the you're gonna still need all the chips, you're gonna still need all the data centers. If it turns out that all those scaling laws are still in effect, and we've only just kind of begun down this road, and ChatGPT 4 is like a baby compared to what's coming. So that could potentially also be the case. And we're going to hear a lot. It's just coincidental that this week is earnings week for all these big companies. So Meta releases tonight, Microsoft tonight, I think, too. So you're going to hear a lot of talk on these earnings calls. And if they say, we're rethinking our capex build or anything along that line, that's not going to be great for Nvidia moving the next week or so. But if they come out and say, look, our capex is still coming, we still have plans to continue to spend this money, and we think that what we're about to release is going to be world changing. So it'll be interesting to see what they say on these earnings calls this week and what these models end up doing this year. But it was a really interesting week because it came out of left field that like what they did this in a closet with,
It's so
with
it's so
old
interesting. It came
chips.
out of left field, right? So you've got the biggest company in the world with, what do you think, Zach? 40 or 50 analysts covering it. And now I never heard this.
Yeah,
No one thought about these black swan events that come out there. And of course, it makes perfect sense that someone would try to approach this huge market from a creative standpoint. And I didn't hear anyone talking about. I'm not following it judiciously, but it seems like no one is talking about this, and everyone was caught on flat-footed on
Yeah,
on a stock that's what's its multiple now? Do you know off the top of your head? It's
30.
ridiculous. Maybe that's not so ridiculous, but um,
No, I'm sorry. Well, 30. I think they're trading like 30 times sales.
this is a good learning moment here. We're talking about price to earnings ratio. You can think about driving down the highway. Like the higher the miles per hour, the higher the PE, the faster you're going, the higher those numbers. A bump in the road can have more catastrophic events effect, right? So you had a company like Nvidia, let's say it's trading at 40 or 50x, the market's trading at less than half of that. It hits a road bump like this, it could have more seismic moves, right? And the same is true of the overall market in general. So I think that's something to be aware of
Definitely.
as we keep our eyes peeled for this. But I think taking two big steps back, what I'm hearing, if we believe you, Zach, and God knows we do, and there's all this bright future here on the horizon for AI and the ways that can improve life, and I think it's possible and true. It seems like we could hopefully, fingers crossed, if this is true, get it for a tenth of the cost. Maybe you're not true if you're data centers and chip makers, but maybe the broader markets really.
Yeah, and I think, and this has been something that some folks have been saying similar type things for a while, that the LLM AI is like the commodity. It's going to be totally commoditized. And some people actually were not particularly surprised by this. I think a lot of folks were surprised by, where it came from and how they did it and the kind of the speed at which it happened. But I think everyone was expecting eventually kind of these baseline artificial intelligence platforms to be cheap and available. It's what you build on top of it, I think, that's going to drive a lot of the value. And that's enterprise level applications, that's robotics applications, it's self-driving cars, like that's all the stuff that you build on top of the original architecture. So there were people talking about that as being kind of the path forward, and that charging for LLM access was never really going to be the major economic driver. It wasn't going to be the value creator. It was more the kind of second order effects of it. But I just think, where it came from and how it was released, and it's like a handful of folks on a side project for a Chinese hedge fund manager, um, with 2,000 chips was what I think was the surprising factor of it. And always going back to, like, is that true? Like, we don't know. They could have done it on. They could have 10,000 state of the art chips that they bought through Singapore. I mean, right? We don't know. So,
Yeah,
anything coming out of China is always, you gotta think twice about it. But it's definitely pretty interesting. So
it sure was.
finally, switch gears real quick to a quick planning item, and this is just something that came up with a client conversation this week, and I thought it would be interesting to share with everyone. So as financial planners, a lot of what we do is retirement income planning, and a big part of that is typically Social Security strategy, claiming strategy. And as you know, you can start collecting Social Security at age 62 and delay it all the way up till age 70 if you want. And each year that you delay taking it, you get more per year. And it's all designed by the bright folks at the Social Security Administration and the federal government to be actuarially equal. That no matter when you kind of claim it, you're really going to get the same economic value based off of like life expectancy. And I think that that's really the wrong way to look at it for most folks that we deal with. And the reason why is because that they base those actuarial calculations off of average lifespan. But that lifespan is very unevenly distributed across socioeconomic spectrum. So if you are in, as you can see in the chart, top 10%, 250,000 and up net worth, your life expectancy is much higher than someone in the bottom 10th percentile of net worth. And so for the folks that we're dealing with who have access to good medical care, they have access to assets, they have access to, preventative health care throughout their life that they take advantage of, healthy food. There's a number of reasons why their lifespan is longer. But that could be an argument for delaying Social Security collection and getting the benefit of that higher payment, because you're going to live longer than the Social Security Administration expects you to, and have a better economic benefit over your lifetime. So,
Such a great point. Do you mind if I supplement with two
yeah,
quick ideas?
please.
I think one of the primary reasons why you ought to focus on this is Social Security ends up being a large portion of folks' pies. Even for the affluent, this is a
It
consideration.
does.
And I think one of the tools that we use in financial planning is, one of the major variables is, what return do you get on investments, but how long are you going to live? Like, how much money do you need, but how long are you going to live? And it's hard to get a pin on that. And most folks in our industry are doing back of the napkin math. But I recommend folks go to livingto100.com. It's a longevity physician. It's a free survey. It's 40 questions, takes 13 minutes or so. And it gives you a great idea of what your longevity is. And then, there's no guarantees, of course, but it's a good practice. It's a good exercise to go through. Number one, you may live a lot longer than you're going to. Number two, one other reason that it's prudent to postpone your Social Security is that most folks are married, right? And most folks, many folks, one partner was working and the other was staying at home or has a much lower Social Security benefit. When the first partner dies, you step up to the original partner's benefit. Okay. You get a death benefit that is the higher spouses. So you go from two to one, but you take, let's say, the husband's benefit, whatever it is. If he filed early, you're stepping up to that. But when you postpone for yourself, you're increasing your benefit and you're also increasing the benefit for your loved one should you predecease them. So, two important
Right.
reasons to think about Social
Yeah.
Security.
Yeah, I love
Yeah.
that. And I love the living. Didn't know about that living to 100, so I'll definitely look at that. It's usually more of an informal conversation, at least that I have. It's more like, let's talk about your personal health history, your family health history, right? Is there any reason to expect
I
that you
call that
won't?
back of the napkin math, like,
But it is,
uh,
it's
you
more,
know,
it's definitely, you can't just look at someone's income level and make a determination, right? You do have to focus on kind of what their, personal health expectancy is. But I love that living to 100. I think that's something I'll incorporate for sure.
my gift to you, my friend. Well,
Love it.
that wraps us up here at Finance Footnotes. We'll see you next time. Have a wonderful rest of your week.
Thank y'all. So many nuggets today.
Oh, it was beautiful. One of our best ever.